Okay,
with an
now I'd like to
American
hand
voice.
over to Kirsty and Laurie, who's going to explain a little bit more about Funder Plus and then take you through the changes to SORP.
Uh, Beverly, this meeting is being recorded, is blocking out the faces. Is it possible to close that?
When you say blocking out the
I
faces,
think, Laurie, you might need to do that on your own screen.
Okay, let me click OK here and see. Yep, done that. Okay,
okay.
thank you. Let me begin. Hello, everyone. Laurie Mutch here, and I'm a volunteer with the Funder Plus organisation, a part of Community Foundation for Surrey. I'll explain what Funder Plus is in a moment. Uh, and when I'm not doing that, when I'm not working with Funder Plus, I'm a consultant and I help startup energy and mining companies raise money and launch on the stock market. So uh, I balance that. I've got that nice balance between charity work and commercial activities. Now, what is Funder Plus? Funder Plus was started about 5 years ago, and I joined around about then, and so did Kirsty. And a group of people closely associated with Funder Plus uh, and CFS, sorry, closely associated with Community Foundation for Surrey, thought that it would be a good idea that in addition to distributing funds, which of course CFS is well known for distributing grants, wouldn't it be a good idea to try and bring together a cohort of volunteers and provide advice? And we've very successfully done this over the last 5 years. Probably accounting advice has been the biggest request that we've received, and we've helped something like 25 charities, perhaps a few more, with their accounting issues. But also we've run workshops for trustees. We've helped charities make their boards more effective and that type of thing. So that gives you a few words on the background to Funder Plus. Shall we begin with the first slide?
Well, Laurie, should I
Sorry,
maybe...
I beg your pardon,
No,
Kirsty.
I'll just say a couple of words about myself. Hello, everybody. My name is Kirsty Garrison. I'm also part of the Funder Plus team, but I have to confess I'm a qualified accountant, but I'm not a charity. I wouldn't say I'm a charity specialist accountant, but over the last few years working with Laurie and the team, I think we've got to know most of the types of issues that smaller charities come across. And amongst, in line with lots of other people, having seen the new SORP, the standard of recommended practice for charities coming out, we've also been trying to get to grips with the bits of it that we think will affect smaller charities. So this is our plan today, is to try and help you understand the kind of key elements of it that are going to be relevant to you, try and demystify it a bit. We're going to try and avoid using too many accounting specialist terms, but inevitably there'll be a little bit of that creeps in, but we'll try and explain what this means to you from a practical perspective. I should probably also caveat this, that again, we're not experts here. We're also trying to figure it out. So please, if you've got complexities, don't just rely on what we're going to say today. You may need to take it away, do some further reading, get some specific input. But our aim today is to try and help you understand the key things that are going to be relevant to you. So then moving on, let me work out how I change the
arrow key.
Yes, I just need to be on the right page. There we go. So look, I think I'll hand over to Laurie. Just to also say that the plan for this is to try and keep the content to about 50 minutes and then leave time for a few questions at the end. We haven't rehearsed this, and there is quite a lot of content to go through. So we will have to see where we get to in terms of timing. But this slide just gives you an overview of what we're trying to cover today. Before I hand over to Laurie to get into some of the detail, as billed, we're going to cover the kind of general principles of charity accounting before we get into the SORP 26 specific changes. But in addition, we're also going to talk to you a little bit about the changes, the audit and examination thresholds, which are also coming in. And I think it's important to understand those to give the kind of wider context to this and for you to think through how the rules might apply to you. And then we're going to spend a bit of time delving into specific topics that we think are the most important to cover, which are kind of listed here with a bit of time at the end to give you some signposts to further reading and hopefully have a bit of time for questions. Please wait, if you could wait until the end. Well, sorry. What we're going to do is ask you, if you would like to ask questions, to post those in the chat as we go. You can post those as you go along, and then we'll have a look at those at the end before and see how many we can cover and if we can answer those. So at that point, I will hand over to Laurie to just give you some initial overview.
Well, yeah, I'm sure you'll be really familiar with this slide and the text on the right, but we thought it was really important to begin the presentation with this opening slide. So, very important to remember that the funds of a charity or charity accounting requires all income, expenses, assets, and liabilities to belong to a fund. And as I'm sure you're all well aware, these are classified as typically unrestricted, in other words, donations or trading income. If you're running a community centre or a cafe or a hall, then you've got trading income, and or restricted grants awarded in accordance with an application that a charity might make for a specific activity or need. So looking at the graphic on the left again, a split between funds between unrestricted and restricted, and in the case of unrestricted, it's general and designated, and then in green, restricted income and endowment, typically associated with a capital grant and the interest associated with that grant. Next slide, please.
Apologies, this is seeming to have got stuck. There we go.
Now, this is probably one of the most important points to make in this overall presentation, and it affects virtually all charities. SORP 2026 emphasizes 3 tiers, and you can see the categories of gross income that separate the 3 tiers. And largely in this presentation, we're going to be covering tier 1 up to 500,000 gross income. And this is for reporting in red. This is for reporting periods beginning on or after the 1st of January 2026. So it's only just been introduced. The SORP is only relevant to charities who prepare their accounts on an accruals basis. Now, we need to be careful here. Charities must prepare their accounts on an accruals basis if any of the following apply: that the charity is registered in England or Wales or Northern Ireland and gross income exceeds 250,000 per year. However, with effect from the 30th of September 2026, this is being increased to 500,000. So essentially that means, in simplified version, that from September, from the 30th of September or 1st of October, if your income is less than 500,000, you don't need to apply accruals accounting. If it's more than that, then you do. All those other conditions apply. These messages are getting in the wake of the slide, unfortunately. The charity is a company registered with Companies House, and the charity governing document requires accounts to be prepared on an accruals basis. If none of the situations above apply, charities may be eligible to prepare receipts and payments accounts, in which case the SORP does not apply, but all other aspects of charity accounting do apply, particularly with regard to unrestricted and restricted funds, and the requirement to manage those funds, each fund, very carefully. Next slide, please.
I think this is where I take back.
Yeah, come in.
So I thought I'd just give you a little bit of background and context to SORP 26 and a little bit of an overview of what's included in it. So I suppose the first question is, why is anybody bothering changing here? And essentially, the way that the charity accounting is set up is it's based on accounting rules that relate to all other general companies, kind of corporates. And that had been changing over the last 3 years. I mean, whether it's a good thing or a bad thing, it could be debating, but the Charity Commission essentially had no choice around this. They had to update and bring the charity accounting into line with what had been happening more broadly. However, I think one thing that was really clear, well, it's really clear from everything that's read, is that when they did that, they very much had in mind that they wanted to distinguish between smaller charities, which they recognise is a huge portion of the charitable sector, who don't have a lot of resources available to them, and it's difficult, and the accounting rules can be very complex, versus the much bigger charities who are much more complex and more sophisticated. So the reason why they introduced these 3 tiers was very much to recognise smaller charities, and they clearly had an objective here of trying to simplify things and make things as easy as possible. So that's kind of just helpful context to what's happened here. As Laurie said, the new rules will come in, or have come in, but exactly when they come in for you will depend on what your accounting period is. So I gave a couple of examples here because these are kind of fairly common ones. So if you're a 31st of December calendar year, you will now be in the rules with effect from January. If you're often, lots of charities have March to April to March year ends, and then you'll be just about to come into the new rules with effect from the 1st of April. And then in terms of what's in here, so Laurie's already touched and I've talked about the 3 tiers with the aim to simplify the accounting for smaller charities. And the way it is structured is that if you are tier 1, you only have to apply the elements of the SORP that apply to tier 1. However, if you want to, you can apply other elements if it's appropriate, or you want to optionally apply rules which apply to tier 2 charities. So there is some choices here. You can take the simplest approach and just follow the tier 1 requirements. If you want to, and this is something that Laurie's going to come on to talk a little bit about in more detail, there are the option, if you're below 500k, to apply some of the other rules. Quite a lot of what's in here is about clarification. So it's helpful description. And also there's some more examples in the description. And again, I think in drafting these, they've tried to come up with examples that apply, again, to smaller charities. We put in here income recognition and expense classification. We're going to come on to a little bit about well, Laurie's going to talk a bit more about different types of expense classification. On the income recognition side, that's probably too much detail for today. So we decided we couldn't talk about it in lots of detail during this presentation, but what we have got included at the end of the presentation, which you'll be able to access afterwards, are a couple more slides which go into a little bit more detail on income classification and recognition. Lease accounting probably is the thing that, if you haven't heard about SORP, it's one of kind of the topical points. This applies to every charity, whichever the size is. They didn't have any choice on this, but I'll talk in a little bit more detail about the fact that they've tried to simplify it for the types of transactions that smaller charities typically come across. Trustees' annual report, we'll spend a few minutes talking about this. This one is an important one. It's not technically accounting, but the contents of this are definitely changing. And I think whatever size of charity you are, this is definitely something you're going to need to pay attention to. And then finally, the statement of cash flows are really just noting on this. This is something that larger kind of middle-sized charities had to do previously. They've now eased this requirement. So this is good news. It's a simplification. It's only if you're in one of the very large categories that you need to, in tier 3, that you need to now include a statement of cash flow. If you happen to be doing one already and you find it helpful, no reason not to carry on doing that. But from a requirement perspective, they've tried to make that simpler. So that gives you a bit of an overview of what's in there and what we're going to talk about today. The other point I really want to just spend a few more minutes on is talking about the other changes to the audit and examination rules that are coming in. So these are outside SORP 26. This is why they're coming in at a slightly annoyingly, slightly different time. But for most of you, they will effectively apply for the same accounting period, this next accounting period. And the key point is that they have raised all the thresholds. So that includes the threshold which you need to apply, you're required to apply SORP 26 if you're a non-company. It's also raised the thresholds for independent examination, both in terms of whether or not you even need an independent examination, and secondly, if you do, whether or not you actually need a chartered accountant to sign off and act as your independent examiner. So again, hopefully these are making life easier if you for those charities who may struggle to find an independent examiner. But again, we're not sitting here saying you should apply these or you shouldn't, i.e. you shouldn't have an independent examination. If you think it's helpful, you can still do it, but these are options. But a couple of words of warning. Firstly, there's the point that Laurie made earlier, is that if you are set up as a company, you still, this threshold, 500,000 threshold, regarding needing, being able to take a simplified approach of using essentially cash accounting, you can't take advantage of that. So if you are set up as a company, you still need to do accruals accounting and apply the SORP. And the other point I think I'd make on here is that hopefully you will probably get the sense to SORP 26 isn't actually too scary. And because they've tried to simplify it, if you're currently already using accruals-based accounting and you and your funders and trustees think this is the right thing to do, it may still be the right option to carry on using accruals-based accounting.
Absolutely.
On the other side, if you're a very small charity, cash accounting you think would work much better for you, but you can't use it because you are set up as a company, I thought it was just worth mentioning that there is a newer type of charitable structure that was introduced a few years ago called a charitable incorporated organisation. And if you're set up as a company and you think cash accounting might be the preferred way to go, you might want to have a think about whether you could convert to a charitable incorporated organisation. Again, just be really clear, I'm not recommending this, but I think it's just worth you being aware of the options if you're struggling with some of the complexities and you're very much a simple organisation and your funders and trustees think that cash accounting is the way to go. Okay, handing back to you, Laurie.
Okay, so you might recall a picture that we had earlier. Tier 1 options with regard to how you put together your accounts. Here's an expression that doesn't sort of fit terribly comfortably, but you can have either natural classification or on an activity basis. And tier one charities may report on either of those, but tier 2 and tier 3 charities must adopt an activity basis for reporting. We'll have bigger definitions of these in a moment or two, or examples. A natural classification allows the charity to choose its own line descriptors for the analysis of income and expenditure. For example, expenditure could be analysed as salary costs, premises costs, grants made, if you do make grants, travel costs, all of those. A natural classification allows you to define your own categories of monitoring expenditure and income for that matter. On the other hand, an activity basis means showing how the charity has used its resources to further its charitable aims. And the charitable activity should mirror those described in the trustee's report. I sense, talking to a few of the charities that we've been working with, that by and large, they are preparing their accounts on an activity basis. Why? Because it links really closely with the grants that they've received and they've applied for and received, and they want to monitor their expenditure against the use of those funds and against keeping a track of the funds being spent on that particular activity associated with the fund. Now, within SORP, there's an example of this. Next slide, please. So this is the natural classification. And here, under expenses in particular, they're just examples. You can choose under natural classification how you categorize your expenses. In other words, whatever works for the charity. Income is a little bit more closely defined because you've obviously got to make a separation between donations and grants and trading activities, but certainly with regard to expenses, you can do whatever you like. Next slide, please. Conversely, on an activity basis, you'll see where I've put the arrows, you need to specify the individual activities, usually at the top of the spreadsheet, and the income associated or granted for those activities, and then the expenses incurred against those activities. And you want to track those either in the context of unrestricted funds or restricted funds. Next slide, please. So let's be a little bit more explicit. Expenses incurred on charitable activities. How do you go about this? This is on an activity basis. Obviously, be clear on which are your activities or projects that realize the charity's objectives in terms of your business plan or in terms of your governing documents. Apply income and funds to, this is blindingly obvious, you apply your income and funds to those activities and you allocate expenses that are an integral part of that activity. So if you're, let's say, have a program supporting mental health in your local community, and you have a contractor who you've recruited specifically who's qualified to assist on mental health. They obviously charge you for that. Well, you would naturally charge that directly to that mental health activity. Again, consistent, as I said earlier, with those activities described in your annual report. And in many instances, you might need to give more attention to those costs, and a note to the accounts would provide further analysis of the expenses incurred. And here's an important point for you. Expenses incurred on charitable activities should include a proportion of overheads. But that, of course, needs to be done on a structured basis. Let's look at the next slide. Now, here we go back to the subject of shared expenses that I touched on a little earlier. These are the salaries of staff or contractors delivering the charitable activities. And let's take another example. If you're running a Scouts organization and you've got Cubs and you've got Scouts and you've got Guides perhaps, and you've got a bus, and you need to monitor the use of that vehicle or vehicles and assign those costs to the relevant fund. In other words, carve them out from classifying them as charitable overheads and allocate them as much as possible to the particular activity. Now, subject to the agreement of the funder per the grant letter, you allocate these shared expenses to restricted funds on a reasonable and consistent basis. And you may well, the treasurer in the charity, may well want to consult with the board, the trustees, as to what the basis might be for doing that. As I've said in number 3 below. Next slide, please. On the other hand, support costs in many respects need to be treated the same way. So we all know what overheads are. Those are the office functions such as administration, accounting, IT, insurance. If possible, allocate them to the activity they support, if it's blindingly obvious which particular activity those types of costs do support. This enables, and this I think is a real objective of SORP 26. The general guidance of SORP 26 is to enable the total cost of an activity to be disclosed within the statement of financial activities. Now, it's common for charities to apply for a percent. Typically, it's 10% or 15% of a grant to go towards charity overhead costs, otherwise known as core costs. Often this, but again, be careful, because often this involves a policy decision regarding the basis of allocation of those overhead costs between restricted and unrestricted funds. Coming back to the point I made earlier, that as much as possible, you want those overhead costs to be charged to activities if you can. You need to be very careful with your unrestricted funds. Your unrestricted funds are incredibly precious. And again, I'm sure you're all aware of this. And under no circumstances, and this is why it's so important to monitor them, under no circumstances must your unrestricted funds go negative. You can't overspend your unrestricted funds. If you do that, then technically you're insolvent, because then one of those restricted fund silos is supporting another one if a particular silo runs short of funds, because the normal way of topping up a restricted fund is using unrestricted funds. Next slide, please. So let's cover this again in summary. allocate grants, donations, and trading income to your restricted and unrestricted funds as appropriate. Typically, as you're well aware, each grant is a separate restricted fund. Allocate direct expenses to the relevant restricted or unrestricted fund in accordance with the grant award. Identify shared expenses and apportion these to the relevant funds using some form of allocation key. And with regard to support costs, those that cannot easily be directly assigned to activities, and those costs are like management salaries, rent, insurance, as I said earlier, typically allocated to unrestricted funds. But again, funders can ask for core costs to be funded by restricted grants. But then what you need to do is to try and allocate some of those support costs in turn to particular activities. That's the overall general direction of SORP 26. Let's see if we've covered all of that. There we go. Here's point 5, the point I made earlier. Closely monitor each category of funds, in particular to make sure, in particular unrestricted, to make sure none are overspent. And transfer unrestricted funds to any overspent restricted activities or funds. And this is why it's so important for your unrestricted funds not to go negative. Next slide. So here we go to summarize the introduction of, or extended introduction of tiers within SORP 26. Tier 1 have a choice between natural classification, and natural classification is the nature of the expense, like insurance or vehicle. That's entirely within the charity's control. Or they can follow the same route as tiers 2 and 3, applying an activity basis. And that's more akin to the way that grants are awarded and is more akin to the way probably that your board works, the charity board works, and certainly is more akin with the way in which you're going to have to report back to the likes of CFS, NHS, the lottery, on how you've spent the money. And then we come on to the subject of income recognition. There are 2 types of income recognition in SORP 26. There's what we call exchange transactions, where you've provided a service in return for income, such as I mentioned earlier on, if you're running a community centre, then you're running a cafe, a hall, a creche, then a service is being provided, and that is an exchange transaction. Whereas a non-exchange transaction, where no service is being provided, would be the likes of a grant. Next slide, please.
Okay.
Over to you.
Yes, back to me. Just one quick final word on this income recognition side. I appreciate we've kind of glossed over that quite quickly. If I've got some time at the end, I might spend a few more minutes on this, but essentially this is to deal with timing of when you recognize income, when you can reflect income in your accounts. So typically, if you get paid something up front, but you might not actually be doing the work on it, providing the service or undertaking the activity until a later period than the one that later accounting period, then you might need to spread that income between 2 accounting periods and wait to book it in your accounts until that later point in time. This is about the fundamental principles around accruals accounting, which essentially says that you allocate your costs and income to the periods in which you undertake the relevant activity or the obligation is incurred. So if your affairs are very straightforward, and everything is happening in the same accounting period, then you don't tend to need to worry about this piece. But I think the other point is that this is a general principle. It's always been there, but the SORP has given us more specific guidance about how you apply the rules. So if you've got that kind of situation where you're receiving money in a different period from when you're undertaking activities, then you need to look at this in a bit more detail. Okay, so moving on, I just wanted to say a few words on lease accounting. So I think this is probably the most accounting technical portion of the SORP that is potentially applicable to smaller charities. But again, what they've tried to do is simplify it. So, apologies if this is getting slightly technical, but I want to say a few words just to explain some of the concepts here. So there's this concept of the distinction between, or there was the concept of the distinction between an operating lease and a finance lease. Now, I suspect most charities don't really come across finance leases in most situations, but essentially, this is the type of lease where it's more like a finance, well, as its name suggests, it is like a lending transaction. So maybe you've gone out and bought a big piece of kit, but you can't afford to pay for it up front. So what you do is you find a finance lessor who will say, okay, I'll pay for it up front, but what I will do is I will charge you over the whole of the life of the asset, or most of the whole of the life. You pay me essentially calculated based on the cost of the asset plus a financing charge. So that was the old, an accounting world. There was this big distinction between that and a kind of normal lease, such as paying your rent. Maybe you might have a rent on a photocopier, or somebody's given you a photocopier but leased it to you rather than giving it, because that's just more convenient. So it used to be there was this distinction. Accounting rules now say there is no longer this distinction. You have to account for them basically the same way. And rather than having a monthly or annual charge for your rental payment, for accounting purposes, you actually need to split it into a depreciation and an interest expense, a bit like you would have done in the old world for a finance lease. So if you have to apply these rules, you do need to spend some time looking at it. However, and there will be some calculations that need to be done to work out exactly how you should account for it. However, I think they've introduced some very helpful exemptions for this, and those are at the bottom of here. So if your lease is less than 12 months, fine, no problem. You don't need to worry about these rules. You probably do need to include some disclosure, some notes in the accounts to explain it, but you don't actually need to change your accounting. Similarly, if it's what they call a low value asset, and they've got some examples in the SORP about that, but again, it's the type of photocopier, maybe some laptops, maybe a bit of furniture, something like that, which is relatively small value. Again, you can generally carry on with what you did before. They're also recognising that a number of charities have peppercorn or nominal leases. Again, there's some exemptions from the rules, some carve-outs from needing to apply the depreciation interest expense. But you'd often need to explain that in your accounts, and there may need to be an extra bit of recognising if it's been given to you at a nominal rate. Effectively, it's a bit like a donation, and you might need to recognise that as in your accounts. So that's a really short canter through lease accounting, but hopefully in most cases, actually the short term and the low value asset will get you out of needing to worry about this. If you've got something more complicated, then I think you're going to need an accountant to kind of help you work through it and work out how to deal with it. But hopefully for most people, this is less of an issue than you might first have thought. Right, so the final point we wanted to spend a little bit of time highlighting is the changes to the trustee report. So again, there are tiering in terms of what needs to be applied for different tiers, but for tier one, these are the kind of key points, is that there's some more encouragement to explain more on these particular topics. And I think the way, hopefully, to think about this is that the purpose of the accounts is clearly a compliance burden. Everybody needs to do these accounts and file them, but they're also an opportunity to tell the story and explain to people, and particularly to grant makers, what the purpose of your charity is, what it's about, how you're managing it, convey the fact that it's a well-run and managed charity, and also, explaining the achievements. And so this really, hopefully, is a positive to, it will require some more work and some more focus, but allow you to spend a bit more time explaining what telling the story of your charity and for example, as it said here, contribution of volunteers, etc. Plus also things like the status of reserves, to give confidence to funders that when they fund you, you will be remaining in existence and continuing, hopefully, and that therefore their money will be safe and well used. So again, we can't tell you everything in a short presentation, but I think that's the other area, and you probably need to do a little bit more reading to look at how this applies to your charity. So I think we've covered most of the content that we wanted to today. The things that we wanted to flag, though, this by no means is a comprehensive webinar on every aspect of what's in the SORP. The SORP is many pages long, but I think hopefully we've managed to highlight the things that are going to be relevant to most of the organisations. A few things to flag that we definitely haven't covered but are changes in the SORP is that if you happen to be a grant making body yourself or giving grants, there's some special rules or more guidance and clarification around those rules. Things like there's more guidance and clarification about long-term assets and liabilities. For some organisations where you have some related party transactions, so for example, if you're set up with a charity and a trading subsidiary, you might need to have some more disclosure around related party transactions. But all of these are detailed that I think for a lot of organisations aren't so relevant. So I'm just having a look to see how we're doing for time. We've actually got through this a little bit faster than we've anticipated. So let me just spend a couple of minutes just highlighting what I've got in the appendices. So first of all, this is something we touched on briefly earlier. This is about the new rules on income recognition and this concept of exchange transactions and non-exchange transactions, which sounds a bit weird, but essentially, as Laurie said, it's about whether or not you are receiving something in exchange for what you're doing. And then if you're into this, there's some rules around performance-related conditions, which are essentially what you've promised to do or deliver. And essentially what they're trying to do is more clarity around when you should recognise income in your accounts, and linking it to when you're delivering what you've promised to do. And so what this might mean is that if you've got some kind of service contract, for example, with a local authority, or you've got grants which are explicitly conditional on you delivering some service or carrying out some activity, then you might need to look at spreading your income. But for most grants, most of what you need to be careful about, say, thinking that because you've got a requirement in the grant to provide some reporting to the grant giver, that's a condition. Generally, that's not, and the SORP is really clear that that's not generally a performance-related condition. Performance-related conditions are all around where the money could be taken away from you if you don't deliver the activity. And then finally, we talked a lot about classification of expenses. There's also some further guidance on timing of when you recognise expenses. And again, for most organisations, this isn't so relevant, but there's some additional guidance around this topic. So I think in terms of the content, the main content we wanted to cover, we've pretty much managed to do that in the 50 minutes. Clearly, we've not been able to tell you everything that you need to know, but hopefully given you some signposts. And what we've included in here is a few links to the specific websites which have the Government and Charity Commission websites which have more detail. We also included, there's lots of other guidance out there. If you just start Googling SORP 26, there's lots of people who've commented on it now. Everybody's had a few months to take a look at it and try and understand it. No particular reason for, particular recommendation, but I did come across this blog by an organisation called Hinchilla, which have a nice little blog around SORP 26 and are kind of, again, focused on smaller charities. So that I thought was quite useful to have a look at and covers actually a lot of what we've discussed today. And then finally, Laurie particularly has been recording a number of other videos, which we're going to be launching on the CFS website very soon. So a little plug for those. They include some accounting ones, particularly delving into some of what Laurie was talking about earlier in terms of tracking your expenses against restricted and unrestricted funds, but also some other topics, including charitable incorporated, CICs, which aren't charities, but are obviously some charity organisations are set up as limited companies. And also some other topics such as risk management and some other kind of trustee related ones. So hopefully when those come out, they may be a useful resource for people. I think we're at the end of content. Laurie, is there anything else you wanted to say? I'll have a look at the chat to see what questions we've had.
Well, I was just going to say thank you both. Thank you, Kirsty and Laurie, for such a clear and comprehensive presentation on what is actually a very complicated subject. Now, we do have a couple of questions. I just want to make sure we answer those within the time. So we've got two from Steve. Steve asks, endowment, can you define this in terms of permanent equity?
This is quite a complicated topic in itself. I think this one probably is outside the scope of this webinar.
Let's take that one offline then. Okay,
yes,
so
I think
you're going to put the contact details in, aren't you, while I'm just fielding these questions?
I will either put them in the chat or I'll give them to you for when to circulate. So one thing we're going to do is circulate the slides, as well as it being recorded, and therefore this will be available on the CSVA website for everybody who's attended or those who were going to attend. We will circulate, I think Beverly, you'll circulate the slides in a PDF format.
Yes. Now there's another question from Steve. Am I right to say early adoption of the SORP 2026 provisions is permitted? What are the requirements for early adoption to be acceptable?
I think there are only very limited circumstances in which you can adopt it early. General terms is it wasn't allowed to adopt early. I can't remember off the top of my head. There might have been a few narrow exceptions from that, but I think the general rule is early adoption isn't allowed. Again, if you follow the Charity Commission and the Charity SORP, look at that. That will tell you what the answer is in terms of early adoption, because they specifically cover that. I'm afraid I can't remember what it is off the top of my head.
Okay, and Paul would like to know, how easy is it to change to CIO?
I've never done it personally. My understanding, though, is that the legal process is relatively straightforward in that it's been set up. There is a transition mechanism, but I would expect you would need some legal support on making that transition.
Okay. And Paul would like to know, if a charity owns a property, does the value of the property have to be recorded in the accounts?
Generally, you would have expected that if you've gone out and paid for it, then you would expect a fixed asset to be on your balance sheet. So yeah, I don't think this is a SORP 26 thing. This is a general basic, general accounting. So if you have paid money for it, you would expect to record it. If, however, you've been gifted it, that's a slightly different situation. And I think, again, you'd need to look at the detail and get some support and advice on whether or not you do need to record it.
Yes, that falls into the category of endowment, and you certainly need to get professional advice on that.
Yes, and Nicola has made the point that using the trustee report is an opportunity to showcase the work of the charity, and felt that these headings would be helpful as more funders, especially as more funders move to invite only, which we know they're doing, and their own desktop research. I mean, I know when I spend a lot of my time looking through charities' reporting accounts, and some have done them in a very showcase kind of way with impact reports, very visual, and others I'm persuading to move in that direction when I have meetings with them. Now, Katie would also say, we have a lease on property. Would we need to make some adjustments into 25-26 accounts?
There isn't a short answer to that one. I mean, it depends on the terms of your property lease. Again, I think it's worth having a look at the specific part of the SORP which talks about property lease accounting and properties to see whether or not you do need to adjust for it.
Okay, now are there any other questions? Okay, because I'm just want to just talk about the next funding surgery, which I've just popped into the chat. So the next funding surgery is on Wednesday, May the 6th, when Give a Little will be presenting on maximising contact donations. And this will be promoted in the funding newsletter in the usual way. But if you're not receiving the funding newsletter but would like to attend this next webinar, please send me an email. Oh, there's one more question from Dora May. Our accounting period is 1st of April to 31st of March. For clarity, could you please confirm the year in which we would need to apply the new SORPs to our accounts?
Yes, so that will be from the 1st of April 2026 for the year ended 31st of March 27.
That's correct.
Okay, so if there's no further questions, I don't see any. No, right? Do shout. I just want to just say another very big thank you to Kirsty and Laurie today for their presentation. I think everyone has found it very helpful, and we had a very, very good attendance. And so thank you both. Thank you everyone for attending, and I hope to see you in May, and the slides will be sent to you. Okay, goodbye everyone.
Bye-bye everyone.
I'll just end the recording.